Okay, what's going on, everyone? This is going to be the video for chapter 12 problems. We have, looks like 7 problems. And again, this chapter we're looking at investments, specifically debt investments, 3 different types: held to maturity, trading securities, and available for sale. Then we'll look at equity investments, how we account for that, namely the fair value through net income method if we own less than 20%, the equity method if we have significant kind of influence. And there's the control, right? If you have control, if you own more than 50%. And then finally on the back end, we're going to look at some life insurance as an investment, how we would account for that. But starting here, right, we're doing held to maturity debt instruments, right? It's like the Charizard. We plan on holding this thing until the end. They give us some information, right? They acquired a long-term investment, namely a $240 million of 6%, right? So that's the stated rate. Bonds. The company management had the positive intent to hold them until maturity, right? So they're held to maturity. The market rate was 8%, right? So we have a difference between the stated rate and market rate there. That's going to give rise to a discount. Specifically, right, they're $240 million bonds, but we paid $200 for them. Interest is semi-annual, and the fair value of the bonds at December 31st, 2027 was $210. Right, so when we talk about held to maturity, right, we're going to put these on the balance sheet at amortized cost. We're generally going to ignore changes in fair value, right? We might put a note in the financial statements, but it's definitely not going to be accounted for in net income there. We do plan on holding them until maturity, but if we happen to sell them beforehand because of unforeseen circumstances, then that would hit the income statement. But let's look for this, right? So for the first one, they want us to do the journal entry for when we buy the investment, right? So for this one, it's going to be debit investment in bond. It's going to be credit discount, credit cash, right? We paid 200 for 240 of bonds, and there was a 40 discount on that. Okay, check, done. They then say, can you prepare the journal entries to record interest at December 31st using the market rate, right? We're going to record essentially our interest revenue, right? So 2 is going to be interest revenue. Here, the actual journal entries, right? It's going to be debit cash for the amount of cash that we get based on the stated rate. It's going to be debit discount because we're going to amortize the discount, right? Get rid of it for the difference between the stated and market rate whenever we account and do the math for that. And then credit interest revenue. Right? So that's the journal entries. Let's talk about what numbers go in there. For cash, right, it's going to be essentially 3% times 240 million, right? 3% because it's 6% divided by 2 because it's semi-annual, right? So it's 7.2. That's great. For the credit to interest revenue, right, this is going to be 4%, right? 8% divided by 2 because it's semi-annual. And we're going to multiply that times 200, right? Basically, our amortized cost on there at 8. The difference between 7.2 and 8, right? We're going to have essentially 0.8 of the amortization there. That's going to be it. All right, let's look at 3. Right? They essentially want to know what will be the carrying value on the balance sheet, right, at year end. So in this way, right, our investment in the bond, right, was a $240 million bond. We have to back out of that our remaining discount, right? So we started with a 40 discount, right, 40 million. But we backed out 0.8 from up here that we got rid of it. So kind of the current amount left is 39.2. You do 230 or 240 minus 239.2, right? That is going to be our amortized cost at the end of the year and how we would put it on the balance sheet. We would ignore these changes to fair value. You might put a note in there, but we're definitely not going to account for it. For 4, right, they say, what if you sold the bonds, right? Some kind of unexpected event happened. Yeah, you planned on holding it until maturity, but suppose you had to sell it, you sold it for 190. Right, in this situation, right, you're going to do debit cash for the 190. Then what you need to do is essentially get the bond off the books, right? So in this situation, we're going to get rid of the remaining discount, right? We're going to do debit discount for 39.2, right? Kind of where it's at right there. We're also going to get the bond off with a credit at 240. If we have our total debits and our total credits, right, to make that balance, right, that's going to be a loss on the investments at 10.8, right? In other words, we sold it. Oh, sorry. Let me just back out, right? Here's the cash we got. We got to get the bond itself off, and the difference is going to be a loss. That goes to the income statement, okay? Let's look at 12.5, right? So this situation, we're looking at trading securities, right? So this is going to be like the Pikachu. We buy this, we plan on trading this bond. They tell us here we acquired as an investment 240 million of 6% bonds. Management is trading, right? We plan on trading these. The market rate is 8%. It looks like they paid 200 million for the bonds, right? So the stated rate is 6, the market rate is 8. They paid 200. Okay, that makes sense. Again, there's a discount. Interest semi-annual, and the fair value of the bonds at the end of the year period is 210, right? So with trading securities, right, how we will present these on the balance sheet is essentially fair value with any changes going to net income, right? So essentially those unrealized gains or losses. So they have, again, 4 journal entries. The first one is whenever you buy the bond, can you please do the journal entry, right? So it will be debit investment in bond. It will be credit discount, credit cash, right? So in this situation, right, it looks like we paid 200 in cash. The face value of the bond is 240. The discount is 40. Very similar, the same as last time, okay? So it's same journal entry for that. 2, right, can you record the interest revenue on there, right? In this situation, it's going to be the same exact thing, right? These journal entries are universal for the bonds. Where things change, right, is going to be number 3 right here. So for 3, right, last time for 3, we had to do the carrying value at amortized cost. That's great. Nothing hit the income statement. But for here, 3, we have to consider the fair value change, right? So what is going on, right? Essentially, as we have here, our carrying value, right, is going to be 200.8, right? We did that math over here. However, the bond in this situation, the fair value at this point in time has gone to 210, right? So we have gone up. The fair value has increased by 9.2. So how we account for that, right, is essentially going to be debit fair value adjustment, 9.2. Credit gain on investment, net income, right? This goes into net income because it's a trading security of 9.2. That's great, right? Then it says for 4, right? Suppose that they then sell the investment for 190, right? So how do we account for that? So for 4, when we sell it, there's 2 things we got to do. First thing, we got to bring it up to appropriate fair value, and then essentially we get it off the books, right? So in this situation, right, we were at 210, right? So we accounted for the change once, but then, right, it goes from 210 to 190, right? So it goes down the value by 20, right? So we need to first account for that, right? We'll do debit loss on investment, net income, right? It's unrealized loss for 20. And then we'll do credit fair value adjustment for 20. Okay, so now it's at the appropriate amount. We've recorded everything already in the income statement. When we get it off the books, it's just kind of a reclass journal entry, right? So we sell it for 190, right? So how would we deal with that? So it's going to be debit cash, 190. We're going to essentially, in this case, do debit fair value adjustment. In this situation, it's going to be for 10.8, right? How did we get that, right? Well, there's 9.2 debit balance, 20 credit balance. The net between those is going essentially to be a credit balance, and we're going to, so it's like over here, it's at 10.8. To get rid of it, we have to debit it over there. So that's what we're doing. We're going to credit the discount on the bond. Of 39.2, so we get that off the books, and then we'll credit investment in bond of 240. Okay, so 190, 10.8, 39.2, 240. What did we do? Right, we got rid of the bond. We have the cash. We get rid of the fair value adjustment. Account for the fair value adjustment, get rid of it. Record it. The income was recorded up here, right, already when we did it, not necessarily when we sold it. All right, let's look at 12.9. They're giving us essentially some information here. This is an available for sale security. So this is essentially, right, when we have AVS, we're going to carry it at fair value, but with changes in OCI, right? So they purchased several marketable securities. The company had investments in bonds listed below. All of the securities are considered available for sale, right? So they're kind of like that Blastoise. Hey, I'm not really looking to trade it, but if a good deal comes along, I would trade it. I'm open to the possibility of selling it. Overall, right, their unrealized holding gains and losses, right? They were at a loser, negative $45,000 for their short-term investments. They were at a positive $20,000 for their long-term. So kind of the net of those two, right? Like what you had good and what you had bad. They were overall at a net $25,000 loss, right? So to record the appropriate journal entry for that, essentially you would do debit loss on investment. This goes to OCI, right? Because it's an available for sale security for $25,000, and then you do credit fair value adjustment. They talk about what amounts would be reported in the income statement as a result. Well, nothing, right? We didn't hit the income statement here, and we didn't sell the stock. All of this is unrealized, right? When it's unrealized, it goes into essentially OCI, but whenever we sell it and it's realized, right, then we take it out of OCI, right? So we put it in OCI, and when we ultimately sell it, we get it out of OCI and put it into net income. So OCI is kind of like a holding pattern until we get there. But that's kind of the setup on it. And again, if you remember from the income statement chapter, it's going to be your net income, right, plus for the period your OCI gives you your comprehensive income. So if our net income was 100 and our OCI for the period, maybe from this was negative 25,000, so it's plus or minus OCI, our comprehensive income would be 75. Typically OCI, I mean, it can be negative, but I mean, it could also be positive. It tends to be more positive in academic examples. All right, here we have various investments. Looks like we have some trading securities, right? We'll make those yellow. We have some available for sale. We'll make those blue. And then we have some held to maturity, right? We'll make those orange. Okay, kind of consistent with what we've been doing. The treatment for each of it, right? Trading securities, just remember, right? It's fair value with net income. For AFS or AVS, fair value through OCI. And then held to maturity, it's an amortized cost, right? It's not applicable for the income statement unless we sell the thing, okay? So they give us all these securities, A through F. They tell us no investments were sold, so these are unrealized gains. All securities except D and F are considered short-term. So D and F must be long-term. If they're not, short-term. They want to know, can you please report the current assets and the non-current assets, right? Well, the current assets, pick a color here that I haven't used, essentially are going to be 910, 100, 780, and then in this case, 490, right? Because remember, this is amortized cost for how we account for it. The other ones are fair value, so you have to kind of pick. That would be wrong if you picked 500. When you sum all those greens, right, the current assets, that is going to be 280. And they want to know the non-current assets, right? Well, in that situation, it's going to be D and F, right? That will be, I don't know, maybe I'll just make that this light green. So for D, we're going to do 915. For F, we're going to do 615. Again, because that one's held to maturity. So the combo of those, 915 and 615, we're looking at 1,530. So this is a carrying value question. They then want to know for 3, any unrealized gains or losses in net income, right? So they're basically looking at the trading securities here, right? We went from 90 to 910, right? So that is essentially a 10 increase. We went from 105 to 100, we went down by 5, right? So in that situation, overall, 5 would be our kind of total unrealized gain that would go into net income. Right? So the answer for 3 is 5. They then want to know how for OCI, right? So that's going to be our AFS securities, right? So we went from 7 to 780, right? That was an $80 increase. We went from 900 to 915. That was a $15 increase. The combo between those two, 95, right, from the available for sale securities, the change in fair value, that will go into OCI, okay? All right, so we're now kind of done with debt stuff. We're going to look at equity stuff, right? We have a company here. Looks like they bought 10% of another company for 50 million. The net income of company 2 was 80 million. The fair value of the shares that they bought was 35 million. There was no dividend during the year. So we have basically company 1 buys some of company 2 10%. So there is no significant influence. There's no control. We're going to account for this, right? Fair value through net income. So they want to know all the appropriate journal entries that we have to do. Well, essentially when we buy it, right, it's just like buying any other stock, debit investment in security, equity security if you want, for 50, right, what we paid, credit cash for 50. We don't have to do anything for their net income. This isn't the equity method. We don't have to do anything for dividends because they didn't declare any, but we do have to account for the fair value adjustment, right? It's going to go through our net income. So in other words, what we started with in this situation is 50, and essentially in that way it went from 50 and it dropped to 35, right? So we're going to do debit loss on investment through net income of 15, right? Because it went from 50 to 35. Credit fair value adjustment of 15. Okay? Pretty straightforward there for number 1. They then want to know for number 2, assume that they sold the stock for 30 million, prepare the journal entries for this. So we sold it, right? Whenever we sold it, because we're accounting for fair value, we need to first bring it up to correct fair value. And then, like we did before, right, bring it up and then get it off the books, right? So I'm just going to put, so in this situation, right, they sold it for 30, right? We now need to essentially, right, we're carrying it at 15 on there. What we have to do, sorry, my phone rang there. Essentially what's going on here is we had it at 50, right? We took it down by 15, right? So it's currently on there at 35. We sold it, however, for 30. So what that means is we now need to bring it down by 5 again to essentially get it where it needs to be, right? So we will, in this situation, copy this journal entry, except in that amount, it'll be in 5, right? So we essentially have the 2 items in net income already. Accordingly, we then can get it off the books, right? We'll do debit cash for what we sold it for, 30. We will do debit fair value, debit fair value adjustment for 20 to get that off the books. And then we'll do credit investment in security for 50, okay? So essentially, right, we have the fair value adjustment. We have the fair value adjustment all on the right. To get rid of it, we have to debit it. Here's what we sold it for, get that off the books. We recognize the income up here, not necessarily on the back end when we sell it. All right, let's look at another problem here. We're looking at the equity method, right? With the equity method, where, you know, the thing that comes to my mind is kind of pro rata, right? We must own something between 20 and 50%. We have significant influence. They tell us here that we have a company and they buy 30% of another company, right? They spend 56 million. During the year, the company, the one they bought, earned net income of 40 million and they paid cash dividends of 125 per share. At the end of the year, the fair value is 52 million. They want to know, can you please prepare the appropriate journal entries? Right, so when we buy it, right, we use the equity method, very similar to before, right? It's going to be debit investment in equity affiliate, right? In this case, what we paid 56, credit cash 56. That's great. Then we have to account for the investment's net income, right? So here, to the extent they made income, we have to include our pro rata share and increase the account, right? So we'll do debit investment in equity affiliate, credit investment revenue for how much, right? Well, it looks like there was 40 million of net income. We're a 30% owner. We're going to have 12 of that be in there. We also have to account for the dividends, right? The dividends themselves aren't going to be income. Instead, they're going to reduce our investment, right? So we got debit cash for the cash dividends, and then we'll do credit investment in equity affiliate for the dividend amount. So here in this situation, there were 8 million shares. There was a $1.25, sorry. Let me make sure I have the numbers there right. 1, 2, 3, 1, 2, 3. Okay, 8 million shares. There was a 30% owner that we are, and it was $1.25 per share, right? So we're looking at 3 million there, and to shortcut it, we can just put 3, right? So we'll do debit cash for 3. We'll assume this is in the millions, and we'll reduce the investment for 3. For the change in fair value, we ignore that, right? We're not going to account for that under the equity method, right? So when we buy it, you record it. With net income, to the extent they make net income, you increase the investment. Or there's net loss, you decrease it. If there's a dividend, right, the dividend decreases the investment on there. All right, one more to go. Looks like we have a corporation. They own a $4 million life insurance policy on its CEO. The annual premium is $70,000. The cash surrender value at the beginning of the year was $21,000. Can you prepare the journal entry, assuming that the cash surrender value increased to 27, right? So we went from 21 to 27, right? It went up by 6. So how we would do this, right? Essentially, it's debit insurance expense for the life insurance policy, debit cash surrender value, right? That's going to be for the increase, 6,000. We'll do credit cash for the 70 that we paid, and the difference to kind of make it plug, or at least the portion for the insurance expense, is 64,000. Okay, so that's kind of number 1 there. They then say in 2, the CEO died, right? Can you please do the journal entry for like the CEO dying and it paying out, right? So when the CEO dies, right, it's going to pay out the 4 million. So you would do debit cash, and that's the starting point, 4 million. Always start with cash. We're going to get rid of the cash surrender value, right? In this situation, it would be a credit to cash surrender value of 27,000, namely the 21 to begin with plus the 6 we increased it. And then the difference between those is going to be the gain on the sale, or essentially the gain from the policy, right? So if we took 4 million minus, oh man, this is not being easy here. Let's see if that worked. No, that didn't work. 4 million minus, I'll just type the numbers in here. It's 3,973,000. The difference if you were to plug it. So you can see, right, we looked at a couple different transactions. Debt, 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 specifically HTM, amortized cost, HTM trading securities, fair value through net income, available for sale debt, the combination of all 3, equity, when you own less than 20%, equity, when you own between 20 and 50, and then life insurance. If you can do these basic examples, you should be good for the exam. With that, I'm going to end the lecture here.